All right, welcome to Talk Tickers. So today, we're digging into a real head-scratcher from CF Industries. They just put up a fantastic quarter. I mean, really solid numbers. But then, the stock tanks, dropping over 4%. What in the world is going on there? Well, that's the puzzle we're going to solve today. Let's dive right in.
Okay, so this is the heart of the matter, right? They beat earnings expectations and pretty handily, too. Now, you'd think that would be a green light for the stock to climb. But nope. Instead, it took a nosedive, plunging over 4%. So the big question is, what on earth did management say during their earnings call that spooked investors so badly?
All right, let's break this down. It's a classic Wall Street puzzle, really. You've got this great news and this terrible reaction. Let's look at the actual numbers.
So, first up, the good news. And it was good. Earnings per share, or EPS, came in at $2.19. And look, this wasn't just squeaking by. It was a really solid beat.
Yeah, you can see it right here. The folks on Wall Street, the analysts, they were looking for something around $2.06. CF comes in and smashes that by a full 6%. Now, in the world of earnings, a 6% beat is a big deal. It's a signal that things are going really, really well, or so you'd think.
And it wasn't just the earnings either. The top line, the revenue, was also super strong. They pulled in $1.66 billion, which also beat what everyone was expecting. So from the outside looking in, it really seems like the core business is just firing on all cylinders.
And yet here we are. This was the result at the end of the day. The stock got hammered down over 4%. What's crazy is that the selling pressure started even before the call, but it really picked up steam once management started talking. It's like the market heard their story and just hit the sell button. So let's figure out exactly why.
Okay, so what was management's side of the story? Well, to put it bluntly, they think the market is just completely missing the boat. They laid out a case for why their company is deeply undervalued. Let's walk through their argument.
Wow, I mean, you can just feel the frustration coming from the CEO, Tony Will, in this quote. He uses words like shockingly low and sickly. He's basically shouting from the rooftops that investors are just not getting it, that they're ignoring the incredible amount of cash the business generates.
So their whole argument really stands on these three pillars. First, they're an absolute cash machine. We're talking a free cash flow yield of about 12%. That is truly elite stuff. Second, they're trying to tell the world, hey, we're not just a boring old fertilizer company anymore. They're pouring money into building this new, low-carbon growth engine. And third, they're giving a ton of that cash back to you, the shareholders, with a huge new $2 billion stock buyback.
But, as we saw with the stock price, the market just wasn't buying what they were selling. So let's flip the coin and look at the other side of this. What were the big red flags that had investors running for the exits?
So we come back to the big question. If the story is so great, why did everybody sell? Well, the Q&A session on the earnings call, that's where the truth really came out. All the questions, all the focus, it wasn't on the fantastic quarter they just had. It was all about the potential risks of the future they were pitching.
And really, this slide sums up the entire conflict perfectly. On one side, you have management painting this picture of a sustainable cash cow that's about to become a cool green growth company. But on the other side, you have the market looking at the same company and seeing a business at the top of its cycle that's about to spend a boatload of money on a super risky project.
Digging a little deeper, investors really keyed in on four major concerns. First, the price tag for this new Blue Point project is massive. We're talking around $4 billion. Second, they won't see a dime of return from that project until 2029. That's a long time to wait. Third, there's a real question about whether this low-carbon premium they're banking on will even exist in a few years. And finally, there's that nagging fear in the back of everyone's mind. What if this is as good as it gets? What if we're at the peak of the nitrogen market cycle?
So, after all that, who's right? Is it management with their rosy long-term view, or is it the skeptical market? Here's our take on what comes next and how we're rating the stock.
Okay, here's our verdict. For the next quarter, Q4, we're forecasting earnings around $2.25. We think pricing should stay pretty stable for now, but we see the stock just kind of stuck in a rut, bouncing between, say, 78 and 90 bucks. Why? Because the market is in wait-and-see mode on that big project. Until there's more clarity, there's just no real reason for the stock to break out. So we're giving it a market perform rating. Look, the company's solid fundamentals are already baked into the price. That exciting long-term green story, it's great, but it needs to prove itself.
All right, but just because we have a neutral rating on it doesn't mean there isn't a potentially interesting trade here. If you're someone who believes in management's long-term vision, there's actually a clever way you could bet on it while keeping your risk in check.
The idea is what's called a long-dated bull call spread. Sounds complicated, but it's not. Here's the play. Step 1, you buy a call option, let's say with an $85 strike price, but you buy one that doesn't expire for a year and a half. That gives you plenty of time. Now, step 2, to make that cheaper, you sell another call option with a higher strike price, maybe $100. Selling that second option brings in some cash, which reduces the cost of your bet. The whole thesis is this. You give the company 18 months to prove its story right. If it does and the stock goes up, you can make money, but your risk is defined and your entry cost is lower because the market is so skeptical right now.
And of course, we have to say it. This is not financial advice.